All right, now let's talk about one of my favorites, the butterfly. And there's a lot of different variations to the butterfly. So I'm not going to go over all of them. I'm just going to go over the regular butterfly, right? But there's different ways to structure them with different ratios of strike prices and the width difference between the short strikes. I'll maybe briefly go over that. So again, stocks trading at 90, okay? And what I love about these butterflies is there's very little risk with a lot of reward. Okay, so the risk reward ratio on these things is amazing. Okay, so and it's very possible. I've made 500, 600, 1,000% gains on butterfly spreads if you are lucky enough and you can time it right. Okay, so let's say stock's at 90. Okay, and I think the stock might go to 105 within the next week. Okay, um, and again, like the butterflies, I like to go about a week or less out. Okay, you can do them, and I know people that do them, a month out or something like that. You're not going to collect much money on them because gamma doesn't start increasing until the closer you get to expiration. So it's more of like a theta collection thing. So you're getting like maybe 10% that you're looking for. But with the way I play butterflies, I like to get like a 50 to 100% gain out of them. Okay. So in this scenario, let's say I think the stock is going to go from 90 to 105. Let's say it's Wednesday. I think it's going to go from 90 to 105 by Friday. Okay. And it might possibly close at 105 on Friday. Okay. And the reason I might, I'm just bullish per my own personal TA and just how the chart looks, but also, I factor in things like gamma and things like that. These market makers like to pin stocks at certain strike prices. So if there's a lot of open interest at that level, then it might, it's more likely that it might close there. Okay. So what I would do is I would buy one of the 100 strike calls, and then I would sell two of the 105 strike calls, and then I would buy one of the 110 strike calls. Okay. So what you end up getting on the risk profile is kind of like this tent looking thing. Okay. So, again, this is 5 wide. We bought the 100. We sold two 105s, and we bought one 110. Okay. And let's say we paid 50 cents for it, okay, or $50, okay. The max potential is 500 or 450, okay. So you're risking $50 to make $450, okay. That's if the stock pins right at 105, okay. Your break even on it is 100.50, okay. Again, if you buy a regular call, your break even is going to be much higher. If you buy the 100 strike call, your break even is going to be like 103 or something like that. Okay. Here it's only 100.5. Okay. And also, if the stock goes sideways up until Friday, you don't lose much value on it compared to a regular call. Okay. So, and the T+1 line is going to kind of look like this, right? But that gets steeper and steeper the closer we get to expiration, okay? And my strategy typically with this is, I'm looking for about 50 to 100% profit on the exit for most of my contracts, right? So, let's say I might do like 5 of these things, okay? For $50 each, so 250 total, right? And I'm looking for, let's say, a double on 3 out of the 5, so a little bit more than 50%, right? So by taking more than 50% off for a double, I no longer have any original capital risk on the table. So I can let the other two ride for, say, I could sell the other one for, like 2.00 and collect 150 on that one, and the other one I might be able to get like 4.00 and collect, say, 350 on that one, right? And this happens, fairly frequently, all right, with the setups that we take. Okay, so that's another reason why I love the butterfly setup. Okay, now very briefly, I will just kind of talk about different setups for it. Okay, so you can do what's called a broken wing butterfly, and it would be unbalanced, right? So instead of it being 5 points from the short strike on the lower end and 5 points from the short strike on the upper end, you might make, instead of 100, 105, 110, you might make it 100, 105, 107. Okay, and then what you end up getting is something that kind of looks like this, right? So your max profit is still at 105, but if it goes above 105 or above 110, or that upper strike, you don't lose any money. Okay, so with the other example, with the regular butterfly, it has to stay pretty much around the 105 area. Like your sweet spot is above 101 and below 109, right? And there's been plenty of times where it's gone above my call strike, okay, my call butterfly, and I end up losing money because of it, right? So the broken wing butterfly, with the more narrow distance on the upper end, is sometimes a good thing if you think there's a potential that it goes, even above those short strikes that you have. Okay, so now let's say your assumption is, okay, I think it's possible it goes up to 105, but I don't think it goes much higher than that. In fact, I think maybe there's a possibility that it might go down a little bit. Okay, so sometimes you can do one of these, right? So if you unbalance it the other way, so I would buy the 110, sell 2 of the 105s, and buy maybe 1 of the 103s or 104s, right? So now you have more upside risk to these. You still have the potential of the max profit at the 105 strike, but if the stock goes down, you actually make money. Okay, so with the unbalanced butterfly, with the strikes more narrow on the lower end, then you make money no matter what on the downside, or you make that lottery ticket win at the 105 strike, right? So, and then these typically, this would be for a credit, right? So let's say it's like 50 cents, right? So it'd be $50, right? So anywhere below, let's say it's 103, okay? Anywhere below 103, you collect $50, right? And then at 105, it would be $250 that you'd make, okay? So that's one of the good things about the variation of the butterfly, okay? And then again, there's even more variations to that, right? Like there's like a 1, 3, 2 butterfly that I use sometimes. Not going to get into all that, but I just want to give you like a brief overview of how to set up those different types of butterflies. And it's the same thing on the downside, right? So I'm not going to go over that. But with the stock trading at 90, if I think it's going to go down to 80, I would buy the 85, sell 2 of the 80s, and then buy 1 of the 75s, right, to make a balanced put butterfly spread. Okay, so if you guys have any other questions about the butterfly spread, let me know.